starting off the new year on a volatile note with the S&P 500 giving back gains after being up nearly 1% at its highs this morning. Here to help chart out the rally's road ahead is Jason Hunter, JPMorgan's head of technical strategy. Jason, good to see you.
Thank you for having me, Mike.
Thanks for coming in. So, kind of a noisy churning action over the last several days. Anything significant about, where this market continues to kind of test this post-election range?
Oh, yeah, absolutely. I mean, we've seen a range since the election, and even today, coming back again to test the bull gap that opened up on election night. So the lower end of that gap, 57.80, give or take, for the S&P, we viewed that as a key near-term support. Thus far, knock on wood, it's held. If that breaks, then the next big supports, and really for the medium-term trend, are down surrounding 5,600.
Yeah, which would get us back kind of to the middle of last year, right? It was kind of like most of that rally from the summer on took place above 5,600. And that would still, in your mind, be in the context of a longer-term uptrend?
Yeah, that's right. I mean, if you look at that 5,600 area, there's a couple of key things there. Number one, when you look at the spring-summertime range, that was the upper end of that range, where the market broke out after the September FOMC meeting. The 200-day average has drifted into that zone as time has passed. And then if you look at, let's say, the November-December price action, even if you look at that as a short-term distribution pattern, that measured move objective sits right on top of that same zone. So I think that's likely to hold if we do pull back, and let's say we will. Sentiment's already come off a good bit just with the December churn that you've talked about. AAII bulls down to 35%. Some of the lowest numbers you've seen since April, when bonds were moving to higher yields again during that period. So the market's done a good bit of work with what's happened in December already in terms of taking some of the froth out of the tape.
And there's a lot of attention, as there always is, about market breadth and whether it's a broad rally or whether under the surface you're seeing wear and tear. And, of course, it's been negative for a while, to the point where I guess it's kind of looking oversold for the majority of stocks.
That's right, yeah. And fitting with that, if you look at things like the percent of the S&P above its 50-day average, back to levels that you saw in April again. And that corrective price action started earlier in December. For a brief period in November, you saw small caps really outperform. A reference back to the 2016 post-election trade. December, that gave up all of that and then some. And like you said, it took the breadth metrics down into oversold levels that we haven't seen for some time. Not
everything certainly kind of flips like a switch on the turn of the year. I'm wondering, though, about some of these relationships. You've been looking at semis versus software. Obviously, semis, a leadership group into the middle of last year. Software then surges ahead. Where does that stand right now?
Yeah, we've seen a couple of potential longer-term transitions. Small versus large has been basing for many quarters now, starting in early 24. Semis versus software is another one where you saw a fairly clear base pattern. And different than small versus large, software versus semis actually broke out late last year. Now, with software underperforming in the month of December, those ratios, both for large and for small cap, software versus semis, have pulled back to their breakout levels. As a technician, that's where it should find support from a risk-reward perspective. If you're going to set your stop, you set it just below the breakout. So an opportunity here that represents an interesting risk-reward setup.
In software,
that's correct, yes.
To resume its relative
that's correct.
outperformance. Gotcha.